Well, good morning, everybody. This is Phil Gibson with the Unity Group at Keller Williams, and today we're recording another video for the Unity thread. I've got Cody Lowe here this morning, and looking forward to having Cody talk to us a little bit about debt to income ratio. And we will kind of kick this thing off. Cody, good morning. How's things going?
Good morning, Phil. Guys, Cody Lowe here with Cross Country Mortgage. I'm doing well. Beautiful Monday morning here. How are you doing, Phil?
I'm doing great. So, hey, let's jump in and tell us a little bit. We've had some questions from some clients that talk a little bit about or have some questions about debt to income ratio, and was hoping you could kind of enlighten us a little bit about how, organizations like yourself calculate that, or how they come about, maybe what the algorithm is, or maybe it's different between different lenders. I don't know, but it'd be great to kind of hear your commentary on that.
Yeah, absolutely. So we'll just kind of do a brief overview. The debt to income ratio is what we calculate to decide, if your income is qualifying for a loan. So when you apply for a home mortgage, we have guidelines that we follow from Freddie and Fannie Mae and Mac. They are the secondary market. Therefore, they are who purchased the loan from us after we give it to you. And they hold on to it for the 30 years so we can kind of rebound our funds and keep selling mortgages on the front end. So they have decided that there is a certain ratio that you need to fit in for them to provide a loan. And so usually that number is right around 49%, depending on your loan program. Some go down to 43. And so talking about that number a little bit, we have a front end and a back end ratio. The front end ratio is specifically just your income divided by the housing expense to give you your front end ratio. So for example, if you make $7,000 a month and your housing payment is $2,000, you are at 3.5%. So then with that, we're going to take and add the back end. So the back end is more of what we look at. This is going to include your income, and then that's going to be divided by your housing expense and all of your other expenses. Therefore, we take into account car payment, credit card bill, student loans, and all of those. We take that into account. So if your housing payment is $2,000 a month and you have a car payment of $500 a month, and say your credit cards are another $500 a month, your total expenses is going to be $3,000. Take that, divide that by your $7,000, and that's going to put you at 42% debt to income. So that's a great standing point. 42% debt to income is really where the secondary market is happy. They think that leaves you with enough room for personal expenses, for example, food, gas, all of those things combined. And then just to build off of that a little bit, they really try to not bog you down. So I've heard a lot out there, 1/3 of your income should be for housing. And so they actually kind of follow that. Now, a third would be around 33% because it's out of a total of 100. So they do give you a little leeway there on the debt to income. And now that's talking about a conventional loan product. But if you talk about a FHA home product, which is the Federal Housing Administration, which was implemented for first-time home buyers, just to help people get into home ownership. There was a certain time in the U.S. economy where it was very hard for first-time home buyers to kind of get in there. Interest rates were high, inventory's low, it's a seller's market. So buyers were kind of in a tough spot. So what FHA did was implement new guidelines. And with that, they let the DTI go just a little bit higher. With some programs, we can go all the way up to 50% debt to income ratio. And that's great. So that gives them just a little bit more room to kind of fit in there. And to build off of that, with FHA, we do lower down payments to help with all that. So for example, everybody thinks the traditional down payment is about 20%. With FHA, we can go down to 3.5%. Now that's huge. If you're doing a $400,000 home, 3.5% is going to be $14,000 versus your average 20% would be $80,000. So that's huge. For first-time home buyers, they don't need to have that one lump sum of down payment. So it really helps them get into the home. Now, to build off the debt to income, we also do VA loans for veterans. Now, there is no front end ratio for veterans. All we worry about is the back end. So everything included, credit card bills, student loans, again, the back end includes all of their monthly expenses. Now, with that, it works a little bit differently. The VA doesn't have a set back end ratio. They do it strictly based off of what's called residual income. That is income left over for feeding your family, taking care of your kids, and they want to see that you have enough extra income to do so. So with that being said, we can go all the way up to about 65, 70. Now that's pretty tough and it really squeezes down on the veteran, but it still helps them get into a home and secure that home ownership. And for some people, that's the most important thing. So that's really great. The veterans, they help serve our country, so we give back to them and really help give a little leeway for them to squeeze into a home there. And then, so some other programs with the debt to income, we also do USDA programs. Now that debt to income is going to be a little tighter. And when you talk about that, they use a household debt to income ratio. So the other programs only do personal debt to income ratio. So if the borrower's on the loan, we only use theirs. With the USDA program, we use everybody in the household, mom, dad. If the son's working, we use his, and if the daughter's working, we use hers. And it kind of groups it all together. So those ratios are a little different. The front end's going to be a 34, and the back end's going to be a 46. So a little less leeway. It doesn't go all the way up to 40, 45, and 50. But it still gives the opportunity for them to get in there. And with that program, you can do a 0% down, as well as veterans, the VA program. So that kind of offsets that debt to income ratio, not having to do that large down payment. So yeah, Phil, that's kind of a good overview of the debt to income ratio and kind of how it works. What other questions do you have in terms of the debt to income?
So thanks for that overview, Cody. That's excellent. What is there one thing when you're working with clients that you're seeing that impacts that debt to income ratio more than, say, other stuff? Is it credit card debt? Is it student loan debt? Is it, what are you kind of seeing there that tends to maybe skew that number a little bit more than, say, other factors?
Yeah, absolutely. So I'm glad you brought up student loans. That's a big one right now. And I want to touch on that. That's a good one. Through COVID, the government passed the CARES Act, which put student loans on deferment. So folks aren't making payments on that. And so when it comes to debt to income ratio, we still need to take that into account unless it's deferred for more than 2 years or it has less than 10 installment payments left. So a lot of folks are thinking, oh, hey, I'm not making payments on that. That must not count, right? Well, and in fact, we do need to take that into account. So what we'll do is take 0.5% of the entire loan amount and work that into the debt to income ratio. And for student loans, for some folks, that can be a huge amount. Student loan debt is increasing in America here, as we all know.
Yeah.
So that's a big one to keep on the radar. Just because it's in deferment doesn't mean that I'm not going to have to take that into account in the debt to income ratio, as well as credit cards. Credit cards get used obviously frequently in the American lifestyle. And sometimes folks run into a certain situation where they have to default on a credit card or come up with a payment agreement with the creditor. And sometimes this ends up with them doing a pays as agreed, or it's just put into default and they think it comes off of their credit and that they don't need to pay it back. But this is actually not accurate. Even if it is in default or, sitting in collection, we still do need to take that into account in the debt to income ratio. And how that goes into effect is there's the total owed amount and then the payment. And once it goes into default or collection, the total amount owed becomes the minimum payment. So we actually need to take the entire loan amount or credit card balance and put that in the debt to income. which really can skew that number off. Say you make $2,000 a month, that's a low number, kind of false
Yeah.
number, but in your credit card, you owe $1,000. We actually need to take that whole thousand. So that puts you over 50 already.
Okay.
So that's very important to remember. Always try to set up payment plans if possible, and always be proactive versus reactive on things like that, because it always does come back when applying for a mortgage. You can get new credit cards. You can go and buy a car with, defaulted things on your credit and derogatories. But when it comes to a mortgage, there's very specific guidelines that we need to follow. And we do take it into account. And sometimes it does affect the borrower dramatically. So
You mentioned any kind of defaults or derogatory items on the credit report. Does any of that stuff ever roll off? I guess, you hear sometimes that you hear about, this 7-year rule where stuff after 6 or 7 years tends to roll off. Is that always evident on the report, or does it truly roll off at some point?
so it really does depend, Phil. It depends, one, which bureau you're referring to.
Okay.
Each bureau works differently. It depends on who the creditor was. It depends what you guys decided to do. Did you just forget about it and hope that it would go away? Did you set up a payment plan? Did you reach out to try to figure it out? And
Mhm.
and so each of those come into effect. And then we do what's called credit repair. So we can actually go in and ask for things to be taken off, ask for things to be revised. We can challenge things if we feel like it was unfair. Um, so really, and then it comes down to what the scenario was. So a car repossession, was it a bankruptcy? Was it just a credit card default? Was it a foreclosure? Each one of those items has a different time zone. So
Okay.
some bankruptcies are 7 years, but if they're still on the credit report, for some programs, we can use a bankruptcy after 2 years, after 3 years. It all depends on the program and which program you fall into. So just to kind of touch on that, we have government programs, and then we have your conventional programs.
Yeah.
Um, the government programs are a little bit stricter on that. They kind of want to see some, let's see, rehabilitation since that problem had happened.
Hmm.
And then the conventional side, you can get a little bit lenient. With the secondary market, there'll be 2 years versus 3 years history. And then for some things, some government loans don't even like to see bankruptcies at all. So, if you've had a bankruptcy within the past 7 years, then unfortunately that's going to ding you and we won't be able to get taken care of.
Okay.
So, but with that being said, if that's the case, we'll just pop over to the other program if possible and kind of fit you in where your situation works best.
Yeah. Yeah.
Absolutely.
No, that's all great stuff. Are you seeing, with, I know you and I have talked about this, the increase in home prices and, making it maybe even a little bit more difficult for that first time home buyer to get into, their first home. What are you seeing program wise that's available to some of these maybe folks that are having some challenges with affordable housing? Their debt to income ratios are maybe a little bit out of whack. Are you seeing some other programs that might be available to some of these folks to be able to get into that first home?
Absolutely. We actually have some cool programs here in Colorado and Denver specifically called CHAFA and
Mm-hmm.
down payment assistance. And so these are great products. And they're not even just for the first time home buyer necessarily, but it's really almost meant for the first time home buyer to help them get in there. And so the name kind of gives it away, down payment assistance. But there's a couple things that I would just like to touch on with these products that I think, information's getting skewed. People are kind of advertising it in a way to hook and bait people, and then things kind of change once they're already locked in and they can't really back out and change their mind.
Right.
So with these programs, first of all, in order to qualify, you need to fit into what's called the medium income. You need to make 80% of the medium income in your area. So if you're doing well and you're in the middle class, this probably isn't the best program for you. But if you're kind of up and coming just got out of school, trying to get your life together. These are going to be the programs for you. Just starting your career, maybe not making that capital that you are hoping on. So how these programs work is it's just down payment assistance, and you can apply for a loan or a grant, and that's the catch. So that's where people are kind of getting confused. They advertise it as a grant, and so you get the money and you never have to pay it back. But only a few select applicants can, qualify for the grant part of the program. A lot of the time it's a loan, and it's called what's a silent second. So it goes on the back end of the loan, and you never pay it back until you get to the last couple years of the loan. Or people are running into it with a refinance. In order to refinance one of these silent seconds, which is the down payment assistance, you have to include it in your refinance. You need to pay it off and actually consolidate it all into one loan. So a lot of folks are, kind of getting surprised by that. They're like, well, hey, I didn't know I was going to have to pay this back. I was under the assumption that it was just given to me. And so I just like to make sure that, folks kind of know that, hey, you don't need to pay it back now. It is what's called a silent second, and it's put towards the end of the loan. So yeah, those programs are great though. They are helping out first time home buyers, low income buyers incredibly. We do them here all the time. And it's cool. We can do manufactured homes. We can do regular homes, attached condos, PUDs, multifamily homes. You name it, we got it. So that program's really helping folks out, and it brings up to 15,000 extra dollars for you in down payment assistance. So
Okay.
that's huge.
Yeah, that's a big deal. Yeah, especially when you're trying to get into that first home, and maybe it's a condo or townhome or something like that. Yeah, that makes a lot of sense. So
Absolutely.
awesome. Well, that's the questions that I had on my mind today. Cody, tell us a little bit about cross country. How long has it been around? And you mentioned a few of the programs that you guys are involved with. Any other kind of caveats that you'd like to share about cross country?
Yeah. So cross country guys, we were founded in Ohio, actually Cleveland. Fun fact, while I'm there, we just sponsored the Cleveland Browns. It's the football team.
Okay.
We're official sponsors, so that's pretty cool. We're kind of making more of a public relations attack of things right now,
Okay.
kind of giving back to the community. We're redoing our headquarters out in Ohio, kind of rebuilding, gentrifying the art district there. So that's awesome. We're going to do a huge campus, add that 500 to 1,000 jobs out there. So that's incredible. But yeah, we're in all 50 states. We're a nationwide lender. We are the #1 non-QM lender in the nation. So that's cool. That's kind of where I want to touch base on. A lot of people are unfamiliar with those products. They're actually kind of daunting, some of our products. It brings back memories of like 2008,
Mm-hmm.
where people were just giving out loans for fun, without kind of really verifying, the credentials of the borrower. So we do a bank asset loan, an asset qualifier, and an investor product on the new non-QM side. And so the investor product might be one of my favorites. It gives investors the opportunity to do 5 to 10 more investment homes than the average lender can give them. Usually there's a limit of 10 financed investment properties, but we
Mm-hmm.
can give you that extra 5 to 10. So you can have all the way up to 20, which is huge. The bank statement qualifier program is a big one for self-employed folks right now. If you don't have the standard W-2 tax forms, or any way to kind of show how you're getting paid other than bank statements, as long as we have the qualifying bank statements to show you get consistent deposits, we can qualify you based off of that. So that's huge. That's kind of helping out the self-employed folks. And then asset qualifier for our older or even younger folks that just have a high net worth and aren't really working day to day, have that solid biweekly paycheck. As long as they have 3 times the loan amount, we can qualify them based off of that in assets. So that's a really good one. And then, I really like to talk about our veteran incentives. And the veteran incentives kind of fall into a community heroes as well. So teachers, nurses, firefighters, policemen, anybody that really gives back. We have a community heroes program that covers your appraisal. We actually pay out of our pocket for your appraisal to get done. So that's huge for some folks looking to get into their house. That's about a $750 to $1,000 upfront expense that we'll cover for them. Kind of ease the process there. As well as that, we have very, very competitive new construction loans for veterans. We have more than competitive rates for them, with loan terms up to 30 years building a new home, so they can get the loan funded while they're building the house. For a new construction, it's huge for some of them. And really, with that program, we don't allow the veteran to put any of their money up front until the house is completely built and done. So that's a huge one as well. And then we do, kind of building off the first time home buyer, we have Home Ready and Home Possible programs, which if again you fall into the 80% medium income, we can give you a better rate. We can lower your mortgage insurance, which is a big deal for some folks. If you don't put the traditional 20% down on your home, your loan to value falls under 80 or over 80%, meaning you need to get private mortgage insurance. Now that can add anywhere from $100. I've seen it all the way up to $300 or $400 per month. So that can be a huge expense for some folks. So really using those Home Possible, Home Ready products helps out with the mortgage insurance. You get 0.5% less coverage is what it requires. So that can be pretty huge for some loan amounts, especially getting up towards the higher loan amounts. 0.5% is going to make quite a difference.
Yeah, definitely.
So yeah, those are some of our other products. And then again, another one I like to touch on, because not everybody has it, is our rural USDA product. And that's for farmers. That's for anybody not in the metro area that has farmland, that doesn't have a lot for down payment. Again, that's a 0% down payment program that we offer. And yeah, it's just a really good overall program. We love to help out the rural farmers. So
good.
Yeah, that's a little bit about us over here across country. A better lending experience. We really focus on the borrower. It's not just another transaction rolling across my desk. We get to know you. We really focus on what's important to you and what's your main goal. So yeah.
Good. No, that's a great recap. I'm glad you got a chance to share some of these other products that you guys have out there. So I think that's it. Cody, I really appreciate you sharing some of these thoughts as it pertains to debt to income ratio and the products that Cross Country offers. And we look forward to possibly some future conversations about maybe some of these other products on the Unity thread.
Absolutely. I look forward to it. Thank
Everybody,
you so much for having me today.
You betcha. Thank you, everybody. And I hope you enjoy this session of the Unity thread. I'm Phil Gibson with the Unity Group at Keller Williams. Have a great day.